We're expecting a few sort of changes from March, if you like. So the first is the vote. We think Dave Ramsden could well go for a cut, and that follows his pretty dovish speech that he gave in at the end of April. We don't think they're going to change their guidance, though I wouldn't discount it in the slightest. If you remember back to March, they shifted the wording of the guidance to suggest that they could ease policy, but at the same time keep it restrictive, which is a really important point that they've been emphasising. And the final thing we'll be looking at this time around particularly is the forecasts. So where inflation is at 2 and 3 years in 2 and 3 years time. Remember, the bank, the way it does its forecast is it takes the market curve, puts it into the forecast, and where inflation is at 2 and 3 years ahead tells you whether they believe the curve or whether they think it's too high or too low, depending on where inflation is. So I think the message is that the market curve is too hawkish, and that there could potentially be a little bit more easing than that market is pricing this year, and the market's currently pricing about 50 basis points of cuts.
Okay, so that's potentially somewhere to look out for in signals as well. And we've been reporting too on this story around the think tank NISA weighing in on tax cuts. And NISA's forecast, which uses a similar model to the Treasury, showing pre-election giveaways won't be possible. And in fact, Hunt will have to do more to balance the books. Does that come as much of a surprise?
It doesn't, and we've spoken about this before, haven't we? That the OBR is quite optimistic about the pickup in particularly productivity growth. And when you look at the bank's forecast today, I know they're conditioned on a market curve that they may or may not agree with, but their view is that trend growth in the economy is 1 and a bit percent. Our view is something similar. The OBR is much higher, so it's up at 1.7%. Now, that doesn't sound like a huge difference, but when you accumulate it over a 5-year period, it adds up to a lot in terms of fiscal numbers. You're sort of talking, the difference between 1.7% growth every year and 1.2% growth every year, you're looking at a gap of maybe £40 billion by the end of the forecast period, the OBR's forecast period, which is 5 years. So it's a big, it could be a very big number. All of that said, of course, we know that the government can play with the assumptions around what they assume about spending, this idea of fiscal fiction that's made its way into the press, and we know that they can massage the numbers to create space to do these tax cuts. Whether it's sustainable or not is obviously a completely different question, and for me it's just not.